முடியலன்னா நம்ம அடுத்த வேலையை பார்க்கலாமண்ணா. வேலையெல்லாம் பார்க்கலாமண்ணா.
Hello.
ஹலோ.
Yes, sir. Good afternoon, sir. You are good to go, sir. We are
Right.
YouTube live.
See, good afternoon, friends. There was some technical problem now that got rectified. We had in the last four classes starting from 1st of April. Till this moment, we have completed 17 accounting standards out of 35. So, all these accounting standards cannot be rated at par with each one. No accounting standard is inferior, no accounting standard is superior, but at the same time, all these accounting standards cannot be taken at par. So especially the last two accounting standards, Ind AS 115, revenue from contracts with customers, the other one being leases 116. Though we have spent some amount of time, I was very anxious that we have got to complete within that time frame given. Today we have just lost around some half an hour or so. But still we can make it out. I mean, still we will be in a position to make it up. As I understand, see, since I am in touch with the students, they were all making an appeal that lease modification would be requiring a little more focus. We are not focused at all. They were all very happy for sale and lease back that we have just done in the last class, especially on class number 4. So it was a good feedback I have just got personally, because some of them, knowing my number, they have just made a call that they wanted lease modification to be carried out. And at the same time, they wanted to have some more problems on 115 also to be done. So I was under the impression that they wanted more on to financial instruments. Students are a little more comfortable in financial instruments as far as problem solving is concerned. Then I just said, okay, we will have it done. Okay, after all, the class is not for somebody's satisfaction. It is a satisfaction of the students community as a whole that we need to take into account. So in this process, I would like to take up on to lease modification to some extent, and on to some of those topics that normally people ignore it. See, cash flow statement, statement of cash flow, inventory, and such of those topics generally people consider as very easy, but they ignore very important points. Now, at this moment, let modification. So we are into page number 59 of NDAS 116, lease modification. A lease modification is a change in the scope of a lease or the consideration for a lease that was not part of the original terms and conditions of the lease. For example, adding or terminating the right to use one or more underlying assets, or extending or shortening the contractual lease term. So modification will have on to many aspects, scope change, The following are examples of lease modifications that may be negotiated after the lease commencement date. Lease extension, early termination of the lease, a change in the timing of lease payment, because every bit is so important in the computation. Therefore, instead of the term being 5 years, it can be extended to 7 years, 8 years, and so on. Early termination. So like extension, there can always be an contraction. Early termination of the lease. Then comes a change in the timing of the lease payment. So there can be various types of lease agreements that they can enter into: ballooned payment, bullet payment, advance payment, arrears payment. There can be variety of financial products that are available nowadays. Then comes leasing additional space in the same building. So beyond the timing, there can always be increase in the space that they are occupying. And same is the way they would be surrendering the space to, see, after the advent of this COVID, the requirement of having an office building of a very big size had come down. So as you find that companies wanted to reduce the cost and thereby extending the office to the home of the employees, and you have the concept of work from home, WFH. So likewise, the business dynamics would always be undergoing changes. It is not that they don't require office and all that. They require an office which may not be required for all that 500 employees or 1,500 employees at one point of time in the same city. So rather, people sitting from Chennai, they can do or operate their official duties from being in Chennai for an office at Bangalore, vice versa. So people who can take an employment in Delhi and still work in Chennai, and once in a month they can go and attend to the meeting. So thereby, from various points, people can work. So I'm just giving you an idea about us, why at all the changes are happening. Next one, if a lease is modified as stated above, the modified contract is evaluated to determine whether it is or contingent lease. If a lease continues to exist, these modifications can result in a separate lease or change in the accounting for the existing lease, and which will not be considered as a separate lease. That is, it will not be considered as a separate lease. Now let us just have a close look at this flow chart. This flow chart will drive home the point. Is an additional right of use granted? Yes. Is the price of additional rights of use commensurate with the standalone price? Yes. Account for the additional right for use as a separate lease. So if you have a extension which is considered to be a separate lease, consider that as a separate contract. If you find additional right of use of asset, you do not consider as as an existing one, or if you find that it is non-existing one, and is the price of the additional right of use commensurate with its standalone price, if it were to be no, then you consider it is an remeasurement. That is, you continue to have the same lease, but there is going to be a remeasurement of liability, and thereby you adjust to the right of use of asset. So I will put it this way. So lease modification. Lease modification can happen on account of variety of ways. Okay. So where you can have only two types in modification, resulting in separate lease resulting in a separate lease, then resulting in no separate lease, but change in lease liability. So lease modification resulting in a separate lease would mean enter into a separate lease agreement. Next one is that resulting in no separate lease but change in lease liability. Change would result in increase in lease liability, the other one being decrease in lease liability. Increase in lease liability would mean credit lease liability, debit should be given to ROU asset. Decrease in lease liability, debit lease liability, credit ROU asset. So what will happen at a point of time? I will just give you an example. From there, you can understand as how it could happen. So we all know that it is a non-cancelable lease only they enter into. Lessee might feel that the lease rental, what he had negotiated for 50,000 rupees per annum, with no change in the facility, he might even be renegotiating it to say some 36,000, because he may be into an industry where he feels that the scope is reduced, his business scope is getting reduced. So he might just ask for the lessor for changes in the lease contract. Though it is non-cancelable, we can as well express our difficult moments, and the lessor can admit, see, for him, identifying a new lessee and getting into an agreement for him is not going to be an easy task. There could always be some waiting time to get a new lessee, and we may not really be knowing what could be the credibility and the type of business that he will be into. And quite naturally, the lessor may be happy to negotiate with 26,000 where there is no change except for the lease amount. Now I will just take up this particular thing through in Excel. Now let us just take up a very simple example only. Very simple example. A number 1, 2, 3, 4. Lease rent 50,000. Then PV factor, let us assume that it is 7%. Discounted cash flow, okay, 169,360. What is the entry that we are expected to pass by year 0? Year 0, the journal entry would be debit ROU asset 169,360, credit lease liability, same figure. So what a lessee is expected to do? He is expected to pay payment, that is lease rental and all that. So you just find 1 year later, they want to change the lease term for the remaining period. So instead of 50,000, 36,000, as I've just mentioned. So year number 1, 2, and 3. 1 year later. 1 year later, lease rent 36,000 for the remaining period. The PV factor is going to be for the remaining period. You find discounted cash flow. So it comes to 94,475. So 1 year later, the figure for lease liability would be 94,475. Now, by year number 1, the lessee, what he would have done, he would have paid for the first lease rent at 50,000, no problem. For that, the scheme of journal entry will be debit finance cost, that is interest, at the rate of 7% into the opening balance figure, comma 0 round. Credit is to be given to lease liability, then payment of lease rental. Debit lease liability 50,000, the first lease rent was paid. Credit was given to cash. At this stage, lease liability outstanding will be how much? This much plus this minus 50,000. It is expected to be 131,215. Right. And not only that, they would have charged depreciation. So this I will put it here. We are expected to charge depreciation. Less depreciation. How much is the figure? Divided by 4. Credit ROU asset. 42,340. So what will be your ROU asset outstanding? So it is going to be 169,360 minus 42,340. So you will have asset for 127,020. You will have a liability to the extent of 131,215. So what normally will be considered as the base for modification is only the liability. And it is not the value of the asset that is taken up there. So revised outstanding is 94,475. So there is a fall in the liability, reduction in the liability. Reduction in the liability, how much? 36,740. Then what is the scheme of journal entry that we are expected to pass for year number 1? Year number 1, we are expected to debit lease liability LL by 36,740. Credit is to be given to ROU asset. How much is that? 36,740. So at this stage, what will be your revised ROU asset? A revised ROU asset will be, our outstanding was 127,020 minus 36,740. So revised depreciation for 3 years would be 90,280 divided by 3, 0. So 30,093. So how the subject matter will be dealt from now on? Correct? From year 2 onwards, how it will be? Year number 2, 3 and 4. So ROU asset, the figure is going to be this. Depreciation is going to be 30,093. Closing WDV, and that will be the opening balance. And here same value and 0 value, correct, for the asset. For lease liability opening, it is going to be 94,475. Finance cost into 0.07. Then lease rent or cash flow is going to be 36,000. And closing lease liability, opening plus finance cost minus lease rental cash flow. So here it is going to be 36,000. The difference between the two is going to be that figure, and in this particular case it is going to be 0. So is that clear? So what it appeared to you at the very initial stage, that it was a contract with 50,000 for 4 years period, when it is getting changed to 36,000, all other conditions will remain the same. There is no change in the space alteration, there is no extension of the time. And same thing, instead of lease rental being 50,000, when it is 36,000, we do not expect that the asset and the liability to follow the same stream. No part of there is, except for the initial stage or at the inception, at no point of time you expect the asset and the liability to match. So they will match at the inception and they will match at the end. In between, you would be finding either the depreciation may be, the depreciation may be accelerated, the WDV may be lower than the lease liability, or it could be the lease liability may be a lower figure when compared to asset figure, whatever it may be. The scheme of journal entries, as you told you, that this is the way it should be taken up. Okay. Some of the very interesting ones in our institute study material they have given. So in fact, in my personal view, this is my personal view, that our institute should have 2 sets of paper for FR. It is so voluminous. In my opinion, even before this advent of new syllabus, I was under the impression that FR by itself should be given as a group. Because with 4 modules that they have and so much for discussion, and limiting that only to 6 questions or 7 questions with MCQ, we will not be in a position to do justice. So students would normally be leaving some topics and go to the examination. If they are lucky, those leftover topics may not be asked and they'll feel very happy and they will be a qualified chartered accountants there. Testing is not completely done. Anyway, this is my personal view. So though it is an institute forum, I thought I will just tell you that is the feel students are getting. It's my feel, but I felt that we should have good scope for asking. Anyway, an ideal student under the new modification should not feel one moment. Yeah. What happened? Want to send? Double check. Now let us just take up on to some of the fantastic problems that we have. This chart that you have will also be a very good chart, and I am one of those fans of CA Institute study material. Not today's fan, right from my students' time onwards, I was a fan of CA Institute study material. Even though there are some human errors there, here and there, they're all 0.01% only. 99.01, the best material. How I am telling this? Not that in a forum, I'm just telling you like this. I am just studying for some other professional course where I'm just referring our institute material. Such materials, that is in US gap. That is a different dimension. It is also good, but there is no support by that professional institute. For any such clarification, I refer only to institute material where I find solution to it. Now let's just go through that. Lease modification, change in consideration. Remeasure the lease liability at modification date, make corresponding adjustment to ROU asset. What we have done now is that 50,000 consideration, we have reduced it to 36,000, we have just done. Imagine from 36,000, it had gone to 50,000. The lessor is asking for change. So he is showing that there is a demand for that particular place and asking the lessee to give way for a new tenant where the existing tenant is saying, I will pay. No, don't worry about that. So change in consideration is a lease modification only. Right. Then comes change in lease term. Change in lease term. What is the change in the lease term? So it could be an extended term or it could be a reduced term. If it were to be increase in lease term, naturally there will be increase in liability, or with change in consideration, change in increase in the term. 36,000 reduction, instead of 5 years, 4 years, it could be 6 years. It could be combination of that. If the lease term is getting reduced, please understand, lease term is getting reduced. Look into that. De-recognize the lease liability and ROU asset to reflect the partial or full termination, and recognize in P&L account the gain or loss on termination of the lease. I hope that you can easily understand when the lease term is getting reduced. Lease liability will be coming down And we can't guarantee that ROU asset value will always be matching at all points of time during the lease term. So by doing so, if there were to be any difference that you get, the difference shall be adjusted through profit and loss account. We will take up that sort of thing also. So students who wanted this lease modification, they will feel very happy then when we just give representation to each one of those. We will do that. Change in scope. If there were to be any decrease in the change in the scope, you got to follow this. Change in the scope where it is to have an increase, consideration not commensurate to standalone price. Remeasure the lease liability modification date, make corresponding change to ROU asset. What is the difference between these two? Same treatment only. Next one, increasing the scope of lease of underlying asset to be accounted as a new lease. This is to be considered as a separate lease. Let's enjoy our moments through example number 34. Example number 34. Modification that increases the scope of the lease by extending the contractual lease terms. One moment. Modification that increases the scope of the lease by extending the contractual lease term. Lessee enters into a 10-year lease for 5,000 square meters of office space. The annual lease payments are 100,000 rupees, 1 lakh rupees payable at the end of each year. Interest rate implicit in the lease cannot be determined. Lessee's incremental borrowing rate at the commencement is 6%. At the beginning of year number 4, the lessee and lessor agreed to amend the original lease by extending the contractual lease by 4 years. The annual lease payment are unchanged, 100,000, that being 1 lakh, payable at the end of each year from year number 7 to year number 14. Lessee's incremental borrowing rate at the beginning of the year is 7%. How should the modification be accounted for? Now, let us just make note of these in understandable short forms, then go for doing it in Excel. Illustration number 34. Original terms, modified terms. Lease rental per annum. Lease rental per annum. Interest rate implicit in the lease. Interest rate implicit in the lease 6%, 7%. Term 10 years. At the beginning of the 7th year, they wanted to amend, extend by 4 years. 14 years. Starting point, year 0, this is 10 plus 4. Year number 7, beginning. Now, how the same has got to be taken up? First and foremost, we are expected to know ROU asset. ROU asset to lease liability by year 0 and year 0. Know that for ROU asset by year number 6, for lease liability by year number 6, number 5, lease liability by year number 6 to year number 14. Item number 6, change in lease liability is 5 minus 4. 7, we will pass journal entry. Let me repeat, ROU asset and lease liability, working note number 1. Working note number 2. Working note number 3. Working note number 4. Now, let us just travel to Excel. Through Excel, we will proceed. Shall we do that? Hmm? That is, year number 6 would mean year number 7 beginning. No. Events are lease number 1 to 10. Lease rentals are 1 lakh, PVF at the rate of 6%. Rhythm. Now, let us just take up on to lease liability. So, 736020. So, என்னாச்சு? சொல்றா. Year 0, journal entry is debit ROU asset credit lease liability 736020. So remember that we have just done this. So this being 2 and 3, we will take up ROU asset at the end of 6th year and lease liability at the end of the 6th year, we will take it up. We will This is for the first journal entry, and now we have to run for 6 years. Year number 1, 2. So we will have both liability and the asset together. ROU asset. Depreciation and WDV. This divided by 10, because we believe that it is going to be for 10 years. So we will be finding ROU asset at 294,408. My lease liability opening is going to be this number. Finance cost, which is going to be 6%. Cash flow is this lease liability closing. Opening plus finance cost minus cash flow. Likewise, we will draw up to 6. Now you would be finding on the asset side lower sum, on the liability side a greater sum. Correct. At this point of time, they want an extension from 7 years to 14 years. I mean, yeah, 4 years extra they want. Now let us just check up. 735,900. So because of the fact that they have just gone in for 3 decimals, we are just getting it. So no problem, we will also be changing it. So don't worry about that. So we will match with everything. 3. So what has happened is that we have made those changes, and because of that, we could match 735,900 here. 735,900. That point of time, we are having 294,360 and 346,355. This is the closing amount outstanding. 346,355, 346,355. So this is what we will be getting it through first one. Working note number 2, we have completed. The first table we have completed, second table we have completed. Now we are expected to take up through working note number 3 for extended 4 years. For extended 4 years, it is not going to be the 6% and it is going to be 7%. Huh? Send only message. So otherwise we would have just taken up the figures year number 7, 8, 9, 10, 11, 12, 13, 14. 8 years we would have taken up these 8 years figures of 620,900 as a figure we would have taken up, but unfortunately it is not that. we are expected to take up for 7%. So therefore, I would like to take up this into the next one and take up this once again in this fashion, but I will take it up at 7%. So here I wanted to take up, instead of D1, it is D14 it will be. This resulting in 597,100. This also we have completed, 597,100. Lease liability in the above case was 346,355. So there is an increase in the liability, that is 5 minus 4. How much is that 5 minus 4? 597,100 minus 346,355. That comes to 250,745. We are expected to pass a journal entry debit ROU asset 250,745, credit lease liability 250,745. Correct. That is what they would have just done. 350,745. Matter over. That is what we have. That is what we are just taking it up as the scheme of journal entries. Now, I just don't want to leave at this particular stage. So now I would like to take up ROU asset to balance brought down ROU asset at 294,360 to lease liability, lease modification, the difference between these two. From there, they are expected to charge depreciation. So 545,105 will be amortized over a period of 8 years. Depreciation per annum is expected to be on this number divided by 8. So it is 68,138 is the amount of depreciation that they are expected to charge. Now, let me just do this exercise for lease liability. By balance brought down is this number by ROU asset lease modification is this number. All this will be happening by year number 7 beginning. Year number 7 beginning. Now let me just take up for 1 year the computation. By depreciation is this March figure by balance carried down is this minus this number. Now you can arrive at the ROU asset, lease liability, on which we will take up to finance cost, which is to be applied at the rate of 0.07 round. Actually, it should be done here. Sorry, by finance cost this plus this into 0.07, 0. Correct. Finance cost, sorry, in this particular case, you pay the person to cash. Amount is going to be 100,000 to balance carried down. How much is that? This minus this. The total is 638,897. This is the way the story should continue. I hope that you people are very clear about how you are going to go about. See, do not get the impression that this is the way it is going to be. Every modification is very unique. Our institute problems are the best. Our institute problems are the best. So this is one such problem we have just completed. ROE asset will be increased by 250,745 on the date of modification. That is the stage at which they have stopped, and we have just run through 1 year. That's the only value addition that we have made. Now let us just take up on to where always remember this particular chart. This I have done. I have taken one example, 50,000, 36,000. Increase in lease term that we have done with the example that we have just taken up, illustration number 34. Decrease. Now we are going to do that decrease. Two types of decrease that you have. Change in the scope also has got the same thing. Change in the lease term will also be having this. Now, I would like to make one modification to illustration number 34. So, this is slight alteration I am making. So, what I would like to do, let me just tell you here. Select a page, copy page, paste page. So, in this particular case, change is there, increase in term, decrease in term I am going to make. Decrease in term. Modified so here I am going to make it as 8 years. 8 years. How this matter will be taken up? Because I don't want to make once again a work. So this working note number 1 will continue to be the same. Working note number 2 will undergo change. So here Excel, I will put it out this way. Sheet number 4, I am creating a copy. Sheet number 4, is illustration 34, lease modification. Under that, increase. Here, next one, rename illustration 34, lease modification, decrease. I don't want to just waste your time, but at the same time, give representation to all sorts of modifications. Closely follow. Journal entry will be this. All this will be there. Here, at year number 6, 7 and 8 only will be there. We will delete this. We will arrive at the value in this fashion. Lease liability, change. I don't want for 4 more years, only 2 more years we want. Correct? Now, what are the changes that we are expected to make? Our lease liability is getting reduced. This got over, this one got over. Now, what is happening is, in this particular case, 735, 900. ROU asset came for 294, 360. 346, 355. Working note number 3, item number 5, lease liability decrease in term. Year number 6, figure is 180, 800. I got to reduce my liability. I got to reduce the liability. What shall we do? Reduction in liability. So now we are expected to make those changes. I think only for this it should be there. For decrease, this is the one that it has to come. Reduction in liability is this much. So debit lease liability 165 555, credit ROU asset 165 555. So your revised ROU asset will be 294,360 minus 165,555. That should be 128,805. 294,360 minus 128,805. Then a revised lease liability is going to be 180,800. So you got to charge depreciation only for 2 years, and you got to pay off in 2 years this liability. That's it. So I think when there is a term change, this decrease should go to this extent, and whatever we have done for change in consideration, increase as well as decrease the same thing. So in the scope, there is going to be some profit or loss. Please closely follow. Right. Correct. So here decrease in term, same like increase in term. Are you clear? Now we will go for change in the scope. That comes through illustration number 35. Question number 35. Watch this problem. Mark it out as very important. Unless the person is going prepared, he will be finding it very difficult to adjust under examination conditions. So mark it out as very, 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 very important. Illustration number 35. It is not decrease in the term, decrease in the scope. That means a higher space that they are sacrificing a big portion and the scope is getting reduced. Now let us just take up. Lessee enters into 10-year lease for 5,000 square feet, 5,000 square meters of office space. The annual lease payments are 50,000 payable at the end of each year. The interest rate implicit in the lease cannot be readily determined. Lessee's incremental borrowing rate at the commencement date is 6% per annum. At the beginning of year number 6, lessee and lessor agreed to amend the original lease to reduce the space only to 2,500 square feet, half of the space of the original, starting from end of first quarter of year 6. Right. The annual fixed lease payment from year number 6 to 10 are 30,000. In lessee's incremental rate at the beginning is not the same 6%. Now it is 5% per annum. So how should the modification be accounted for? So like working note number 1, working note number 2, working note number 3, and working note number 4. Now let's start. So how to carry out under examination conditions, that also I will tell you. Please just don't worry, since we have the scope of Excel, we are doing it. Otherwise, annuity factor we will be using. That's it. So please just don't have a feel, oh, this much I got to work under examination conditions. So please just do not express any such feeling. You can have annuity factor and work out faster than what I'm just doing. So here I'm just using Excel only for the purpose of arithmetical accuracy. Year number 1 to 10. Events are lease rental 1 to lease rental 10. Cash flows are 50,000. PVF taken up at 6%. free. Year 0, debit ROU asset, credit lease liability. This is the journal entry that we are expected to pass. Okay. So this is the first working note. Second one, we are going to do it at the time when change is to be made. ROU asset, depreciation, closing WDV. This figure divided by 10. Opening lease liability, finance cost, cash flow, say now let us just run through the 6. So please just understand a very important thing is that this much is for 5,000 square feet. Now the scope is getting reduced to 2,500 square feet. 5,000 square feet to 2,500 square feet. So therefore, you cannot be just doing like how we have just done in the last two cases or 3 cases. And we have just done only in this process 2 steps only we have just done. The third one we are expected to do. What is the scope for year number 6? The original term is not undergoing any change. Events are PVF. Now what? 5%. lease liability. All of you, please just be careful in our computation from now on. So all of you, please be careful. The cash flow, let us just check up regarding the cash flow. $50,000 is what they had, no. Here it is going to be 30,000. That we have not just made a change. Okay, all of you closely follow. That I have forgotten. Now I have made the change. So space ROU asset for 5,000 square feet, the value on this date is 147,180. For 2,500 square feet, how much it should be? $147,180 divided by 5,000 multiplied by 2,500. So that means what happened? Expenditure. They replied. So you just call him and tell that it was sent. Huh? One moment. Revised ROU asset shall be divided by 2. 73,590. So scope reduced, my ROU cannot be altered here. You got to be very careful. So in the case when there is no change in the scope, only the amount of 50,000 lease rental got reduced to 36,000. The first example which I have just given, ROU asset was changed. That is alongside of lease liability we have changed. 2. One moment. Ask him to come here. 2. Revised ROU asset we have just worked out. See, let me just repeat once again. I just got a disturbance here. So now let me just take up the first one. No change in the scope, no decrease or increase in the term. It is only the lease rental change. We have to make change both for ROU as well as for lease liability. When we had a modification in the form of extension or reduction in the term, ROU is to be altered because the scope changed only for the term. In this particular case, what had happened for 5,000 square feet, it was 147,180, the remaining WDV to run for 4 years. When that scope is getting reduced from 5,000 to 2,500, the revised ROU asset should also be reduced accordingly. It should be taken up at 73,590, half of that, right? Now that the liability is also getting reduced. So reduction in liability, lease liability is equal to this minus this. So 66,799. So we are expected to make changes to lease liability. Lease liability to be reduced. Lease liability to be reduced. ROU asset to be reduced from this figure to a revised figure is this much. So reduction in the liability and reduction in the asset, the balance to be transferred to P&L account. It is 6791 is the change that we are going to make. Let us know about what is the journal entry that we are expected to make. Say liability to be reduced, where I got to debit. Debit lease liability is this much. Credit ROU asset 73590. Debit loss on change of terms, change of scope. $6,791. Let us just see. So some other factors also we need to take up. Let us just check up one by one. 367,950. Let us just see. 367,950, correct? Working note number 1 over. Say now let us just see the change. So I think I've just committed the mistake of taking it up from year number 7. Hey, no problem. We will make those alterations. No big deal. So it is lease rental 6. No big deal. I just did not read out this properly. No big deal. So we will just do that. So if your ROU asset were to be 183,975, 183,975. This is expected to be a round number. Round. Extremely sorry, I just did not notice it properly. It's my mistake. So lease liability to be reduced. Reduction in lease liability should be here to here. Correct? ROU asset has got to be reduced to this extent and balance to be transferred to P&L account. So debit, let us just see that. 183,975. 183,975, yes, right. 129,900. 50% of the liability 105,273. Oh, the liability also to be reduced to that extent. Extremely sorry. So as how we have just done this, extremely sorry, that portion we have not just done that. Scope of liability reduction. Scope of lease liability reduction is exactly half of this. So, increase, see, when scope is reduced both for, when the scope is reduced, we got to make change both for asset as well as for liability. I was just focusing on asset. I've forgotten to take it upon the liability. So, scope of liability reduction is 105,273. Now that has got to be increased here. Right. So now let us just go through that. So 50% modification we have just carried out. Now the lease recognizes the difference between the lease liability 104,273 to 129,900. Where from we are just getting this to this. So increase in lease liability, this minus this, right? 24,627. So here I'll make new changes. So we have 24,627. That is the increase in the liability that we have got to make because of the change that had happened. And ROU asset cannot be decreased beyond this particular stage. And the difference between the changes happening in the asset and the liability should be routed through profit and loss account. That is what they have just given. Have a closer look at this. Lessee reduces the carrying amount from by 91987.5. Revise this one. Reduction in ROU is going to be this minus this. That is what you have. And the carrying amount of the liability will be reduced from 210 to scope reduction is to this extent. And because of the change in the lease liability, there is going to be an increase in lease liability. Increase in lease liability 24,627. So let us just complete through a scheme of journal entry and find out the gain or loss. That would be always be better to do. This is illustration number 35. Say number 1. Debit lease liability. It should be 105 273. Credit ROU asset 91987. There is going to be difference that you are arriving at to the extent you can put it temporarily as a gain. 13 280. 2, we are taking up credit lease liability where there is a change in the lease liability 24627 and debit to a loss that you have 24627. So if you compound these two, see here we are not taking it up in full. You just see there is a decrease 13 to 87. So I would like to bring out a fulsome solution. Just watch out. From here, let us just read. Lessee determines the proportionate decrease in the carrying amount of ROU asset on the basis of the remaining ROU asset. 2500 square feet to 50%. That we know half of that we will take up both for ROU as well as for lease liability. Consequently, lessee reduces the carrying amount and the carrying amount of liability, recognizes the difference as a gain. As a gain that we have just taken note. Lessee recognizes the difference between the lease liability which equals to 24,627 to ROU reflecting the change for the lease and revised discount amount. Where would they just debit? As an adjustment to ROU asset. Yes. Extremely sorry, this portion is ROU asset. This portion is again, this portion is a ROU asset. Why? Because this change is only towards the asset. This change had happened in the form of gain. So initially I told you that it is a loss. Please understand that it is not a loss. The scope, when it is undergoing a change, here in the format, we have said remeasure the liability and make a corresponding change. Here de-recognize the lease liability and ROU to reflect and recognize the profit or loss, the gain or loss on termination. And one cannot be leaving it at that particular stage. You should also be following remeasuring by making adjustment to ROU. So that is a point I thought I will just tell you. So in a way, we just got into a right frame. So all of you please just understand this scheme of journal entry is for change in the scope of lease liability and ROU asset, where 50% reduction in liability, 50% reduction in ROU asset. So the difference resulted in gain. So here increase in liability is solely attributed to ROU asset. Kindly make that change. Initially, I just conveyed it as it is a loss. Actually, it is not a loss. That is to be taken up as ROU asset. Market order is very important. So when there was a change in the term, I just got different numbers at the initial stage. I just made the modification. Okay. So mark that as very, very important. Following are some more examples for lease modification. So at this moment, let me just take up 10 minutes break. Then we will take up on to some more modification and then we will take up on to cash flow statement of cash flow. Okay. Yes. We will share this. We are resuming it. Yes. Reduce my voice. Gopala. Reduce my. See, I have just used these sort of Excel sheets. Increase, decrease, and all that we have just done. No. Now I would like to tell you under examination conditions how you got to do it. How you are expected to do it. So you don't have to take this much of time or this many cash flows to be multiplied. So for example, when it is illustration number 34, under examination conditions, how you have to do it. Under examination conditions, how you got to do it. Please just don't worry about today that we are concentrating more on lease modification. Lease modification also it will enable you to understand some of the AFM concepts also. Just watch out. So the first working note that we are developing 735 900, we all know that when the cash flows are going to be the same, the annuity factor is going to be 7.359. Step number 1, initial lease liability and ROU asset is equal to annuity factor multiplied by lease rent 7.359. 7.359 multiplied by 100,000 is going to be 7,35,900. So somehow we understand that students may be good in accounting, but may not be that fast in using calculator for finding out PV factor and annuity factor. So 6%, all of you, how we normally do is that 1 divided by 1.06, you will press 1 for the first year, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 times when we do that, we have GT total. Through that, we can just get this number as 7.36008 and all that. So those who are having that GT function, you can do it. See, many times people just do not take care as whether they are getting into a right calculator before going to the examination. So even if you do not have grand total, you can find out the annuity factor. How do we do that? So annuity factor is equal to one divided by 1.06, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You will be having that grand total, you may not be having. 1 minus PV factor divided by cost of capital. 1 minus 0.5584 divided by 6%. You will get this number. Even if you are not having grand total, you can get it. So what is the number that you will be ending up with? 0.4416 divided by 0.06. You get this number. So that is the reason as why I told you, you just do not have any feel that I do not have Excel and all that. Please just do not complain. World is full of opportunities. We should not be complaining. So this is the way step number 1 should get over. Okay. Step number 2, even there also, it should be getting over faster. So on this particular case, ROU asset for year number 6 end should not be a big deal. ROU asset for which 735,900 divided by 10 multiplied by 5. I am talking about the latest problem. One moment, let me just check up 34 problem. Problem number 34. This is the problem. Correct? So, multiplied by 4. 10 minus 6. How much is the remaining life that you have? That is going to be your opening WDV. So, 735,900 divided by 10 into 4. 294,360. 294,360. So it may not be appropriate to do all the 6 years deduct. How much you deduct is going to be the same number, straight line method. So working out for understanding is one thing, and reworking it for the purpose of under examination condition. You should not feel that it is going to take long period of time. No. If you understand the topography, just like that, you can finish it off. So as part of step number 2, lease liability here, you do not have any other scope but to work out for like a passenger train only. What is that? Year 1, 2, 3, 4, 5, 6. This portion for which there is no shortcut technique, this is going to be we do not have any other scope but to have it worked out like this. Right. Here we do not have. So therefore, you take into consideration these two numbers. Correct? Then what is that you will be doing for step number 3? This is for year number 7, 8, 9 and 10. Huh? Not this, huh? These numbers. Is that right? The original one. Not this one. Am I doing 34? 34 only I am doing. One moment. Yeah, 34 only I am doing. No, any problem that you do, for that, how shortcut is what you are expected to use. That is what I am teaching. Correct? 34 increase. This is the way we normally do. For an extension, you are expected to arrive at this total annuity factor. Step number 3, new lease liability on extension. Annuity factor into lease rental 5.971 multiplied by 1 lakh, 5,97,100. Correct? If this be the case, we are expected to take up step number 4 in less than a minute's time. What is the increase in liability that we are going to take up? 346, 355. That has got to be reduced from 597, 100. 250, 745. 250, 745. Debit ROU asset 250, 745. Credit lease liability 250, 745. Matter over. How much time we are expected to take up? Nothing big. Though it sounded big, just for the sake of understanding, it was just done. So you can carry out with least amount of time getting engaged. Is that clear? So this is a point I thought I will just try. And all of you, please just understand the last problem, illustration number 35, in which when you are making those half of that, when you are just making, there is going to be a distortion in the assets and the liability. On account of that, it will result in gain or loss. Whereas on account of increase in liability solely attributed for the ROU and asset, then you got to debit only to ROU asset, not to loss. Initially, I told you as loss, actually it is ROU asset. So therefore, it is a combination of these two. Now, I think we have just made adequate discussion about lease modification. Let me just check up if there were to be anything very interesting beyond that, whatever we have just done, we can try one more. Now let us just take up on to one more, and then we will take up to statement of cash flow statement. Statement of cash flow. Illustration number 36, modification, there is change in consideration only. This, of course, we have just done that. My example was that. Let us just read out. So this is nothing but from 1 lakh it got reduced to 95,000. Okay, that we have just done. Now let us just take up now to 37 will be really a challenging one. Mark it out as very important. Let us just try this. Lessee enters into 10-year lease for 2,000 square meters of office space. The annual lease payments are 100,000 payable at the end of each year. The interest rate implicit in the lease cannot be readily determined. Incremental borrowing rate at the commencement is 6% per annum. At the beginning of year 6, lessee and lessor agree to amend the original lease to A. Include an additional 1,500 square feet of space in the same building starting from year number 6 and reduce the lease term from 10 years to 8 years. The annual fixed payment for 3,500 square feet is 150,000 payable at the end of each year from year number 6 to year number 8. Lessee's incremental borrowing rate is 7% per annum. So from what it was considered to be, let me just complete the consideration for the increase in scope of 1,500 square meters of space is not commensurate with the standalone price for that increased adjusted to reflect the circumstances of the contract. Consequently, the lessee does not account for the increase in scope that adds the right to use an asset additional space, additional 1,500 square meters of space as a separate lease. How should the said modification be accounted? What are the two changes that they have just made simultaneously? Illustration number 37. Huh? No. See, the major scope in change, old and the new. We have area 2000, 3500. Term 10 years. Here it is going to be 8 years. Lease rent modification not applicable hereby year number 5 end. Correct? Beginning of year or year number 6 beginning. Then KO is 6% and 7%. Step number 1, ROU asset and lease liability. Annuity factor at the rate of 6% for 10 years multiplied by lease rental. Check it up as whether it is 7.3601 multiplied by 100,000. Let me just check up whether they are rounding it off. So originally they have taken up 7.3590. We will fall in line with that. Year 0, debit, ROU asset 735,900 that is credit lease liability 735,900. Step number 1 over. Step number 2, ROU asset at year number 5 is going to be 735,900 divided by 10 multiplied by 5. Half of that. $367,950. Then year number 1, 2, 3, 4 and 5. Opening lease liability 735,900 finance cost at the rate of 6%. 44,154 cash flow 1 lakh closing lease liability. எங்கடா அவ்வளோ சவுண்டு? $680054. $40,803. $620,857. $55,8108. 55,8108. 33,487. $491,595. 29,496. Plus 491,595 minus 1 lakh is going to be 421,091. Lease liability 421,090. So we have just got it. And ROU asset 367,950. So we have just completed 2 steps. Right. Now, what are the changes that we are expected to make? So 1,500 square meters of space in the same building. And because of that, the change had resulted from a lease rental of 100,000 to 50,000. People can easily identify as increase in space to increase in lease rental. That is the conclusion that we normally be making. But here, in order to prevent that, they have just brought out this last paragraph. The consideration for the increase in the scope of 1,500 square feet of meters is not commensurate with the standalone price of that increase adjusted to reflect the circumstances of the contract. Consequently, lessee does not account for the increase in scope that adds the right to use an asset additional 1,500 square meters of space as a separate lease. So the lessee is telling that this 50,000 rupees increase is not on account of 1,500 square meters of space. This also takes into account a reduction in the term. So that is the one that they are telling. Is that clear? Now, at the effective date at the beginning of year number 6, the lessee remeasures the liability. A 3-year remaining lease term. So 6, 7, and 8. This is what we normally be trying it out as step number 3. We will just do that. So here is a place where we will take up the new lease liability at the rate of 7%. So which is going to be annuity factor at the rate of 7% for 3 years. So year number 6, 7 and 8 at the rate of 150,000. So how much it comes to? So it comes to 2.6243. So instead of doing that, we will take up the total 0.935 plus 0.873 plus 0.816. The annuity factor is 2.624 multiplied by 150,000. Okay. Gopala? Gopala? 393,600. That is what they have just given. The modified liability equals 393,600, of which 131,200 relates to the increase of 50,000 in the annual lease payment from year number 6 to 8, and 262,400 relates to the remaining pre-annual installments of என்னாச்சு இதுக்கு See, now let us just take up the discussion and we will run through these things and complete the solution. So we have up to this modification. So we have to be a little more careful. All of you, please just have a closer look at the discussion, because I just don't want to separately work out, but at the same time explain what is there in the institute study material, because people at the end of the day, they just expect how to solve under examination conditions. So out of those 4 steps that we used to do, 3 steps we have completed. Now in this problem, there are some difference with the other problems that we have worked. Now let us just take up that. The modified liability equals 393,600, of which 131,200 relates to the increase of 50,000 in the annual lease payment from year number 6 to year number 8, and 262,400 relates to the remaining 3 annual installments of 100,000 for year number 6 to 8 with a reduction in the lease term. What is this? Where from we are just getting it? So when you know this figure itself, you can subclassify into 2. So that 100,000 that was originally agreed, 50,000 this because of the increase in the space. So if you take up this 393,600 for 150,000, for this 1 lakh of rupees, it should be 262,400, and the balance, how much is the balance? The balance is going to be 131,200. Am I right? This is what they are telling. So sometimes you require some better presentation. So if you read a statement like in the form of a paragraph that you find there, it may not make any sense. Possibly with this help, you will be understanding it better. That is what I am doing. There is a very, very small value addition that I am making. That value addition is going to bring a lot of confidence to you. So I am telling you that institute is the best way of doing. But thing is that at a little or in some places it may be a little hostile. Decrease in the lease term. At the effective date of the modification by year number 6, the pre-modification ROU was 367,950. Where is that we have got? We have got 367,950. So ROU asset is 367,950. Lessee determines the proportionate decrease in the carrying amount of ROU asset based on the remaining ROU asset for the original 2000 square feet of office space, that is a remaining 3-year lease term rather than the original 5 years lease term. At the end of the 5th year, so you are having only 5 years of scope. That is why we have said in our computation, it is 5 years, which is nothing but 10 minus 5. Correct. So here, what is that they are telling? Decrease in the lease term. So you may have to read once or twice to understand it better. Okay. So because to that pitch, when we got to go, we may have to increase our scope. That is, we have to increase our level. Let me read it out. At the effective date of the modification, that is at the beginning of year number 6, the pre-modification ROU is 367,950. No problem in that. The lessee determines the proportionate decrease in the carrying amount of the ROU asset based on the remaining ROU for ROU asset for the original 2000 square meters of office space. That is the remaining 3 years lease term rather than the original office term. Correct. Original 5 years office, that is lease term. The remaining ROU for the original 2000 office space will be 22750. How come? 367,950 you took it for 5 years remaining. Now that you reduce, you find the term is getting reduced from 10 years to 8 years. So how much is that on account of that 3 years? When you check up, it comes to 22770. Now I will do that exercise for you. So this 367,950 ROU asset. So you just find 367,950 where you can split them into 3 years and 2 years. That is what they have said. For 3 years, it is going to be 220,770. Originally, I would have charged depreciation of 73,590. What is that? 73,590 was per annum depreciation into 3. So how do you get? Or 367,950 divided by 5 multiplied by 3, or per annum depreciation for 3 more years comes to 22770. Correct? At the effective date of modification at the beginning of year number 6, the pre-modification lease is 421,090. They are talking about liability now. Right? So at the effective date of the modification, the pre-modification lease was 421,090. The remaining lease liability for the original 2000 square feet of office space is 267,300. On what basis they say it is 267,300? So 267,300 for which they have given the computation. Present value of 3 annual lease payment of 100,000 discounted at the original discounting rate of 6%. Please refer to note number 2. In note number 2, where is that note number 2 they are referring to? Yes. So 267,300 is what they are telling. Okay. As per the original term, when you just move like this, you get this 267,300. We understand that. Lease liability of 421,091 you would have done for 3 and 2. This portion they are telling it out as 267,300. How come? This is the way that you work out 1 lakh into annuity factor at the rate of 6% for 3 years. That is the way you work out. You can just check up, no problem at all. Now, consequently, lessee reduces the carrying amount of ROU by 147, 180. 367, 950 minus 220, 770. So they are talking about these two. So ROU asset is getting reduced for the 2 years portion. So that is the reason as why I have just made this sort of presentation rather than reading out this statement. So when this were to be for 5 years, 3 years and 2 years when you have taken up, the balancing figure you can arrive at easily as 367, 950 minus 220, 770. If you reduce, this comes to 147, 180. This being the balancing figure, we are arriving at 367, 950 minus 220, 770. Is that right? This much of reduction is on account of reduction in the time. Are you clear? And the carrying amount of the lease liability by 153, 790. So this reduction, what is a sort of reduction? Which is 421,090 or 091 minus 267,300. How much it comes to? 421,091 minus 267,300. How much it comes to? It comes to 593. Sorry, 153,791. Correct? All of you, are you understanding? I hope that you people are following it up. Just because this breakup is provided, lessee recognizes the difference between the decrease in lease liability and decrease in ROU asset as gain or loss in profit or loss at the effective date of the modification, just like the last problem that we did. So this much of reduction in asset, this much of reduction in liability. So reduction in asset is less, reduction in liability is more. This will result in gain. How come? Debit lease liability. Liability is reducing more than asset decrease. ROU asset 147, 180. Credit gain. What is the difference between the two? 153, 791 minus 147, 180. So 6611. Maybe 1 rupee difference you will be having. Are you clear? This is what you find in the scheme of journal entry. 153, 791 debit. Credit ROU asset 147, 180. Credit gain 6610. I hope that this point is clear for you. So this working is going to enable you easily understand this portion. Are you clear? Mark it out as very, very, very important. Right. Next. Now we are expected to proceed further. So this item is for reduction in the term. Reduction in the term, we have just making the change in the liability, change in the asset, and the difference we have taken to gain. Now, let us just come to the scope increase. At the effective date of modification at the beginning of year number 6, lessee recognizes the effective remeasurement of the remaining lease liability, reflecting the revised discount rate of 7%, which is 4,900 as an adjustment to ROU. So, what is the change that you find there? So, where are those numbers that you are ending up with? So, please just understand that your lease liability at the rate of 7% is giving you 262,400, Whereas it comes to, in your old computation, 267,300. Whether lease liability got reduced or increased. Can you just say that because of that 7% when you are using higher PV factor, you end up with reduced figure? Because of the fact that you are using lesser cost of capital, a higher PV factor will be there, and because of that liability is more. From a higher liability, you are taking to a lower liability. So therefore, there is a reduction in liability on account of change in the cost of capital. This portion has got to be adjusted with ROU asset. So please understand, here is the place where I wanted to tell you. So we are talking about 1 lakh and 1 lakh only. We are not talking about 50,000. So please just understand that owing to change in discount rate for the same lease rental liability of 1 lakh with higher discount rate. Owing to change in discount rate for the same, here itself owing to change in the discount rate for the same lease rental of 1 lakh, higher discount rate equal to lower liability. Correct? So debit has got to be given to lease liability, credit is to be given to ROU. Correct? How much is the figure? 267,300 minus 262,400, 4,900. Correct? All of you, are you understanding this? Mark it out as very, very important. Now, we have made change for reduction in the term from 10 to 8. We have just made 6% to 7% we have made. Now we have only for 1,500 we have got to make those change, and that is what we are expected to take up. That being 131,200, we will pass one more journal entry: debit ROU asset 131,200, credit lease liability 131,200. Matter over. Are you clear? So this one, they are talking about this table not required at all. So the matter is over at this moment, but let us just look into the question. How should the modification be accounted for? That's all. Solution is ending at this particular stage. But why that extra table that they have given is for a simple reason, is that we are having a liability at 421,091, and because of the journal entry that we are passing by debiting lease liability, once again lease liability, and crediting to lease liability would mean our lease liability is getting reduced. And how we would run for year number 6, 7 and 8, that is what they have given here. So how that will be taken up and how ROU asset will be taken up, that also we can do it. So all of you, let us just understand revised lease liability. Before modification, it was 421,091. Reduction in term 153,791. Reduction in KO 4,900. Increase in scope 131,200. Now this is going to be your revised lease liability. Let's take the calculator and find out. 421,091 minus 153,791 minus 4,900 plus 131,200. So this comes to 393,600. 393,600, you got it because of this only. They have not shown this sort of adjustment there. Now revised ROU asset. Revised ROU asset before modification. Before modification, it was 367,950. 367,950. Reduction in term 147,180. Reduction in cost of capital 4,900. Increase in scope 131,200. Let us just find out one by one. 367,950 minus 147,180 minus 4,900 plus 131,200. It comes to 347,070. Please just check up. 347,070. Refer working note number 5 and all that they have just given. Okay. Now, for the remaining 3 years term, year number 6, 7 and 8. ROU 347,070 depreciation divided by 3. 115,690 closing. Opening ROU, closing ROU. Two three one three eight zero 231,380 115,690 115,690 115,690 115,690 0. Then lease liability opening. Lease liability opening 393,600. Finance cost at the rate of 7%. 393,600 into 0.07. 27,552. Cash flow. Cash flow of 150,000 and closing lease liability. 393,600 plus 27,552 minus 150,000. 271,152. 271, 152. 18,981, 150,000. 140,133. 140,133. Here, I will not calculate the interest. This is going to be 0. From here, 150,000 when you do, it is 9867. 9867. 115,680. So you do not have any inhibitions that we are not in a position to get institute answer. It is not like that. We can do it in our own way. That is the reason for the last one, I don't want to do it by Excel. I wanted to live with the students. The way in which they write under examination conditions, that is the way we wanted to do. What are the changes? You had area scope, term reduction, cost of capital change. So each one we have just separated. The effect of those we have taken in our computation, and adequately we have made those changes in their respective accounts. Okay. So to a very great extent, I would just say lease modification is over. Sale and lease back over. This way we will go out for threadbare analysis on even revenue recognition, financial instruments, and consolidation, business combination. These are the areas that we will focus more, and we will do adequate justice in the times to come. So I would like to take up at this moment, we will change our scope to cash flow statement, statement of cash flow. Statement of cash flow. See, now let me just introduce to you the first problem. Cash from operations by direct method and indirect method from the following information. Second part of the question is a full-fledged problem under indirect method. Third problem is consolidated cash flow. So consolidated cash flow can be handled only after consolidation is over. Consolidation, we have done only two problems. So right at the very initial stage, I was having this particular thing running in my mind. So for the minimum coverage, we thought we will just try all this. So understand, once we are conformably doing this, we will, I mean, these areas, consolidated cash flow, we can take it up. Now let us just take up the first part of the question. And before I could take up for the first part of the question, certain important things that you should be remembering. One moment. See, as far as the cash flow is concerned, there are two methods that you have. One is direct method. The other one is indirect method. Correct? One is direct method, the other one is indirect method. So one moment, I will just so people keep calling, no, so I got to inform them that I will be available later. Direct method and indirect method. This is only for operating activity. For investing and financing, both are same. So direct and indirect method is applicable only for operating activity, investing and financing, both same. That means there is no difference between direct method and indirect method. This difference is there only for operating activities. Now, after this, I wanted to tell a very important thing because they concentrate on certain issues. So I would like to take up through our institute through institute study material we would like to take up. Let me just stop this and share that institute material a little later. So now let me just share. So what are all the items that will come under cash and cash equivalent? Cash balance, bank balance, and any short-term security which are having maturity of less than or equal to 3 months. As on the date of investment. So if the investment period is exceeding 3 months, even if that investment were to mature within few weeks of the year end, we will not take it up as cash and cash equivalents. From the date of investment, if the investment period were to be less than or equal to 3 months, only such investment will be taken up as part of cash and cash equivalents, not to be counted from the year end. That is point number 1. Point number 2, we have accounts receivable. Accounts receivable will be factored, that is discounted, where you have two types of discounting. One is without recourse, the other one is with recourse. One is without recourse, the other one is with recourse. What do you mean by with recourse? What do you mean by without recourse? Say when any factor is or when any accounts receivable is given to a factor. A factor is a person, is a banker, basically take the receivable, provide the money. In case of any default caused by the customer, the money will be collected from the person who discounted in the case of with recourse. That means the responsibility will not be taken by the banker. The responsibility will not be taken by the banker in case of any default committed by the customer. This businessman has got to repay the money to the banker. This is with recourse. I have a way to move. That is recourse. When you have without recourse, what do you mean by without recourse? Where the factor will absorb the risk of bad debts. Why we should discuss something about factor, accounts receivable, without recourse and with recourse and all that. Now, you can understand that with recourse would mean under which activity it will come. Without recourse would mean it will come in different activity. I want you people to think it over, even though we do not have a parallel communication between on an online basis. I do not check up what answers that you provide. But I am telling you, for a moment, you just ask yourselves, what is that? When you have a factor with recourse and without recourse, how they got to be treated? I have a receivable where I sell the receivable on a temporary basis, and when it is not collectible, I will take the responsibility back. Would mean, what is that sort of activity? So I take loan and I repay the loan when it is not successful. This is one factor, that is recourse. Without recourse would mean I sell this to you, I will not repay at all. Whether it is financing or not financing, that you got to think. Therefore, it becomes all the more challenging when you are taking up such adjustments. Now I will show you that these items are there in our institute study material. Now I will take up that and show you. Now I will share the screen to you. All of you closely follow. This could be an MCQ question, which could be a possibility. So please be careful. Illustration number 5. An entity has entered into a factoring arrangement and received money from the factor. Examine the said transaction and state how it should be presented in the statement of cash flow. So using factoring arrangement, it needs to be assessed whether the arrangement is recourse or non-recourse. Recourse factoring. The cash received is classified as financing cash inflow as the entity continues to recognize this receivable, and the amount received from the factor is indeed a liability. That is what I told you. When I am just taking the money, I am taking the responsibility of repaying the money when something is going wrong. So I continue to hold the liability. The substance of the arrangement is financing, as the entity retains substantially all of the risk and the reward of the factored receivable. Naturally, I take up the responsibility. I take the money on a temporary basis. When the cash is collected by the factor, the liability and the receivables are derecognized. it is acceptable for this to be disclosed as non-cash transaction because the settlement of the liability in the factored receivable does not result in cash inflow. The net impact of this transaction of the cash flow statement is to present the cash flow from financing. It is not about as whether journal entry is to be passed when the money is collected by the factor. It is not that. For the money that we have taken from the factor, where would this item be shown? This item is to be shown under financing. But there is no operating cash flow from the original sale of entity's customer. That's all. So, for when it is with recourse, it is financing activity. Without recourse would mean that is non-recourse. When an entity derecognizes the factored receivable and receives cash from the factor, the cash receipt is classified as an operating cash inflow. This is because the entity has received cash in exchange for receivable that arose from operating activity. So, with recourse would mean liability is associated. Liability is associated. Therefore, it is financing activity. No liability is there. No liability is associated. No liability is associated. Therefore, it is operating activity. These sort of finer points you need to understand. Except that, absolutely there is no difficult moments on cash flow statement. Consolidated cash flow statement is a challenging area that we will handle it later. So, this is what we have, and what we do in the case of cash flow statement. How do we prepare? We prepare in 5 different forms: cash flow from operating activity, cash flow from investing activity, cash flow from financing activity, increase or decrease. In fact, one more we will have in cash and cash equivalent, opening cash and cash equivalent, and closing cash and cash equivalent. So, if you consider this as A, B, C, D is equal to A plus B plus C. And if this is E and this is F, F is equal to D plus E. Correct? So, indirect method is what in majority of the places people follow. When we are preparing under indirect method, a cash flow statement, we say net income would mean profit after taxation. To that, we will add back whatever debits that we make into profit and loss account, which are considered to be non-operating, non-cash items. Add back what? Tax provided, depreciation charged, then loss on sale of PPE. These items we normally debit, no. This figure we have arrived at after reducing these items. So therefore, we are adding it back because these are effects of non-operating. They are no longer they are no longer operating items. So we are adding it back. So items that we reduce could be gain on sale of say PPE, investment, etc. This we have got to reduce. So here when I just put it out as less, automatically that has got to be reduced. Say I don't want to do double negative. Then we are expected to add this and arrive at. Then comes less tax paid. Why tax paid is taken up only against operating activity? Is it not appropriate to take a portion coming under investing? Maybe if that is possible to differentiate, you can do it. When there is a tax associated on account of gains upon sale of PPE, investments, etc., that portion alone can be deducted from there. But an entity is primarily in existence, generating income only through operations. So therefore, people consider that majority of the tax payment is only from the operation. So therefore, they take it as a matter of routine that it will be deducted only from operating. If at all you are having that additional information, you can do that. Then we will make those changes. What sort of changes that we will be making? So changes in current assets and current liabilities, or I would just say, I will add decrease in current assets and increase in current liability. These items we will add. We will deduct increase in current assets other than cash, reduction in current liability, and this figure we will be taking. This is what we normally do. Now, this is what we have it in IFRS and Ind AS. So international practices also we do have. So here I would like to make those small changes. Net income, we will be making it up. Here I am going to add interest charged into my P&L account. So this is what we have it in India and IFRS. If it were to be in US GAAP, interest charge will not be added back at all. Interest charge will not be added. Rest of the matter will be same. Imagine that if it were to be gain on sale of PPE, dividend received from subsidiary, we will reduce. In US GAAP, we will not give space there. There will always be a logic, no? So you need to know the logic very clearly. So what in US GAAP they tell is a very simple fact. So which is also correct. Say, I cannot be differentiating that interest is paid, is financing and all that. Say in US what they say, to run the business you require money, which you would have borrowed. You require money to run the business you have borrowed, and therefore interest has got to be paid as any other expenditures. For example, I take a place for rent, I pay rent. For the space that I'm using, I'm considering that as my operating expenditure. Requirement of money is there in any business, quite naturally interest payment is also to be taken, just like how I take space for rent. So that is their aim. Therefore, they say interest payment will not be added back in IFRS and Ind AS. They are very strict. You have to add. Dividend from subsidiary. Why in US it is like that? See, why I am telling is that So why you find dividend for subsidiary in US? See, I'll tell you what is the reason and all that. See, briefly, a little away from the topic, let me tell you, in India, we have for one professional course like foundation, you have intermediate, you have final, you have foundation, 4 papers, 6 papers in intermediate, 6 papers in final. If you take up a parallel course in USA, we have only 4 papers. That's it. No inter, no foundation, no final. Only 4 papers. And no descriptive paper, and it is MCQ and task-based simulation. So it's not that you tick and clear very fast. It's not like that. 40 to 50% pass rate you have. So there also you have US gap, and they call it out as accounting standard code. Huge numbers that you have. More than this 35 you have it in US gap. Why they say, what is the wisdom that they have to not consider dividend from subsidiary? Here we are taking it up, we are deducting it here. What is the logic behind that? Also, no, I am holding some investments in my associate, in my subsidiary. What for? Is that I want to generate regularly the dividend as my source of income? No. So practically what happens when I'm holding some controlling interest or significant influence on another entity, it is for the purpose of getting my raw materials which are supplied by my subsidiary and by my associate, where I need to get on regular basis at the appropriate intervals as I require and at a concessional rate. So therefore, my investments cannot be disassociated with my operations. In order to have a smooth operation, I need to have, or I need to don the role of an investor. I need to don the role of investor, and only then I will be getting. If I got to don the role of a joker and make a comedy, I got to do it for the purpose of running my business. So investments with associate and other entities like subsidiaries are not intended to have dividend as the main source of income. I'm just holding it for getting my raw material, getting my technology, getting my intangible assets, getting my support from these entities. Only then I'll be in a position to run the business smoothly. That is smoothly. Therefore, holding in other entities, they consider as matter related to operations. So with an intention to make operational gain, they are holding this investment. So therefore, we are having this. So that is the only thing that you have. The rest of which, the concept wise, they're all same. Okay. This is under indirect method. Direct method, what is that we will be doing? Direct method would mean we will take up collection from customers. Payment to suppliers and cost. This is the way we will be arriving at. Please understand whatever figure that we will be getting out here, and this number and this number should be same. To get the collection from customers, you got to prepare sundry debtors account with opening balance to balance brought down, by balance carried down, to sales made, and by cash collected. Only this figure we will be bringing it out here. So from cost of goods sold, we are expected to arrive at the purchases, opening stock plus purchases minus closing stock. This may be provided, this may be provided.